towards achieving your financial freedom. Open your CDS account and trading account today. Happy investing!
What's up, everybody? Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. So today we are very excited because we are going to do this topic, which is how to invest in commercial real estate via REITs. Now, I'm sure all of you here would have learned about property investing one way or another. So today we're going to learn how to use real estate investment trust to invest in commercial real estate. Like we know, right? Some of the real estate are in a very, very prime location. And in property, right? Property investing, we learned that location is the top three criteria in selecting property. But somehow these properties are in a very prime location. Property could be very expensive for us to afford it as a small retail investor. So today we will learn how to use real estate investment trust to afford this prime location property. Okay, and some more real estate investment trust is a financial instrument that is tax efficient. Okay, so today our speaker will share with us how to use REIT to invest in commercial real estate. So as usual, disclaimer, whatever I share on this webinar is only for educational purpose. So we never give any buy or sell recommendation to any company. So whatever discussed here is only for case studies and for educational purpose. So if you decide to make any investment decisions, you are 100% responsible for all your investment risks. Now, allow me to introduce our speaker today, and he is a content producer of kclao.com. And personally, he has written over 100 plus articles on kclao.com. So he's a KC Lau sidekick, okay? So he's also a weekly webinar host and presenter. He is also the co-founder of dividendvault.com, whereby they manufactured savvy investors who can build dividend-based portfolios independently in Malaysia, Singapore, and also Hong Kong. Now, he's a dividend investor. He invests primarily for dividend income, and dividend yield every year is 2 to 8% per year. So, ladies and gentlemen, here you go, Mr. Ian Tai. Ian, how are you doing today?
Hey, Shane. Hey, my man. Hey, guys. What's up, man? How are you guys doing? Hope that you are doing okay.
Yes.
All right.
Yeah.
So maybe we can actually start off the presentation, all right, by allowing me to share my screen. Okay, let me just put this on presentation mode. Okay, so yes, once again, it's always a pleasure to be on Shane's platform and to be also on the circuit list, on the speakers list of Bursa Malaysia to actually present this webinar session. Now, just to start off with a warm-up question, perhaps you can actually type in the chat box. How many of you have actually invested in a Malaysian REIT? So if you have, maybe you can type in what is the Malaysian REIT that you have invested into. If let's say you are new to REIT investment and you have not actually purchased anything, perhaps you can just type no, I'm new or something like that. Maybe Shane, you can actually just monitor the response.
Yes, boss.
Yep. So what did our audience say?
Okay, waiting. See, let me go through. Majority are new lah.
Majority are new.
Yeah, I would say maybe 20 to 30%. Yes.
20 to 30%.
Yeah.
So I would say that 20 or 30% of the audience today, they bought something, or the 20 or 30% they are talking to, they are actually quite new to REIT investment.
New, not yet. Yeah.
All right.
Majority is new, not yet bought any REIT before.
Okay, fantastic. Then I believe that this session will be an eye-opener to you. All right, so I have prepared a lot of stuff today. So with that, let's get into it. Right. Okay, so this is the main objective of this webinar. So in this webinar, we will explore a few things. Number one, I'm going to just give you an overview of the REIT market in Malaysia. Number two, I'm going to share with you the characteristics of a wealth building REIT, because not every single REIT are the ones that are making money for investors. Some REITs are making money to investors, some REITs are not. So we will actually want to find out what are the characteristics that we need to look out for in order to choose the REIT that can make you the money. And then the third one that I'm going to discuss with you is that this is a very important topic because we are going to talk about financial results. So a lot of things, right? Whether it's stock, I believe it's all about stock investing. Stock investing, right, to me is about financial results. Okay, so which means to say, if you do not know how to interpret financial statements of a company, then stock investing to you can be a very risky venture. If you know how to assess the company's financials, then I would say that you can reduce your risk by a lot of times, but very significantly if you know how to if you have that accounting skill or that skill to actually assess the finances of a company. And then the fourth one what we are going to do here is we are going to calculate the net distribution yield of a REIT. Now, a lot of people, okay, maybe you can type in the chat box. For those of you who are investing, who have some experiences in investing in the stock market, do you guys use screeners? Okay, like KLSE screener or our very own Bursa marketplace. That one is also a screener. How many of you use a screener? So Shane, maybe you can monitor from our chat box, our universe of audience. How many people actually use screeners when investing in a stock?
So far, 95% is yes lah.
95% is yes. For a REIT, right, I believe that it is very hard for you to go and calculate the net distribution yield of a REIT. Okay, there's a reason for it, and I'm going to just keep it as it is because very few screeners are going to do very detailed calculations like what I'm going to illustrate to you later on. So which means to say later there will be a part of this webinar where I'm going to illustrate how you can calculate the net distribution yield of a REIT. Very important. And finally, to do all this stuff, right, we are going to do a case study walkthrough of an actual Bursa listed REIT. Okay, so these are the main objectives of this webinar. Now let's move on to part one, the overview of the REIT market in Malaysia. So in Malaysia, we have about 14, in fact, right now we have 18 REITs. Okay, so there's one REIT that I didn't really put it into it, which is the IGB commercial REIT. So that one is actually the latest addition to our REIT market in Malaysia. So what happened here is that in all our 18 REITs that are listed on Bursa Malaysia, we can classify them into two categories. The first one is Sharia compliant REIT, and the second one will be conventional REIT. So what is the difference? Here, in brief, I would say that Sharia compliant REIT, right, they will basically rent out to tenants who are Sharia compliant, which means to say their business activities must be Sharia compliant. Whereas for conventional REIT, they are not restricted to this kind of limitations. All right, whereby, for example, let's say we have a REIT and it has invested in a portfolio of properties. So these properties, right, they can rent it out to, let's say, Carlsberg. Okay, they can rent it out to bars, to do nightclubs and pubs activity to actually get rental income. But if your REIT is under Sharia compliant REIT, basically there is a limitation to that. Okay, so you can't actually rent out to tenants who are engaging in not so Sharia or non-Sharia compliant kind of activities. So that's the distinction between the two. Okay, and now we can actually classify the REITs based on the types of properties. So here I have actually classified them. I have listed them into 6 different categories. So let's go through them one by one. So the commercial properties, the type of commercial properties that they can go with will be, they can invest into retail malls like shopping malls. So over here we have IGB REIT, where IGB REIT, they only have 2 properties, Mid Valley Mega Mall and the Gardens, which is right beside it. And then we have CapitaLand Mall Malaysia Trust. And then we have Hectare REIT, KIP REIT, and Pavilion REIT. And then the next one, we have office buildings. So here I have stated 2, but actually right now we have 3. So the first 2 will be Tower REIT and UOA REIT. Now we have the third one, which is the IGB commercial REIT. The fourth one, the third category of properties is industrial. So we have Axis REIT and we have Atrium REIT. The fourth one will be a pure play hospital REIT, which is Al-Arka Healthcare REIT. This one, they will invest in REITs. They will invest in properties, hospitals, right? these are KPJ hospitals, all right? These are all KPJ hospitals, okay? Because Al-Aqar Healthcare REIT is actually quite closely tied up with KPJ Healthcare Berhad. So that's very important. The fifth one would be hotels. So we have YTL Hospitality REIT. And finally, we have a diversified REIT. So what's a diversified REIT? Diversified REIT means to say they can invest in a number of properties, like a different type of properties. Like for example, let's say KLCC Staple Securities. If you say they have office buildings only, that's also incorrect because they have office buildings, they have Surya KLCC, which is the retail property, they have the convention center, they have the hotels. So it's quite diversified, okay? And over here, we have 6 different diversified kind of REIT, okay? So that is actually the list of REITs that we have in Malaysia based on the types of properties that they have, that they can invest into, I mean. Okay, so with that, we can actually move on to the second part of this webinar where we are going to talk about what exactly do we need to look at before we invest into a REIT. So this is the characteristics of a REIT that I will be looking out for. Okay, the first one. So here, what I will do is that I will basically use a framework. Okay, so for me, when it comes to REIT, I will actually go through this investment framework. So this thing is actually very important because to me, right, I don't pick stocks on a random. I tend to actually put all the REITs, all the stocks right into an investment framework. But specifically for REIT, the framework right will consist of 4 different criteria. So they are as follows. The first one will be, I will actually check out the property portfolio because we are investing into a REIT and REITs are supposed to hold properties. So therefore, the first thing that I will do is to understand the property. What do they have? What kind of properties do they have in their portfolio? Okay. So over here, I want to see that the REIT, right, there are a few things I will look at. Number one is that over the span or since their IPO to where it is right now, do they expand their property portfolio actively? Let me say when they are first listed, right, they may have certain amount of properties. And right now, right, after so long, right, after a period of time, has it actually grown their property portfolio? All right, so these are the things that I would actually look at. All right, because I don't want a REIT whereby, you know, starting point, they may have a few properties. 10 years later, they still have that few properties. Okay, so this is actually the thing that I will be looking at, whether or not they can actively expand their property portfolio. So that's the first criteria. The second criteria that I'll look at is this. When you expand the property portfolio, you keep on buying properties, right? So what brings in the income are actually tenants. So you want the properties to be occupied with tenants. You don't want a REIT to buy properties, right? They are always very high in terms of their vacancy rate. There's no point in buying a piece of property and let most of their spaces, right, empty, vacated, or something like that. So I will actually monitor on a year-by-year basis the REIT's occupancy rate, the overall occupancy rate. So the overall occupancy rate must be above 90%. Then I would say that, okay, you know, these are quality properties. These are properties where tenants are actually demanded by tenants. All right, so good to have the mute button, sorry, clear my throat. All right, so let's move on. All right, and of course, when it comes to property portfolio, I will also measure the total asset value. And if let's say the property portfolio continues to grow, the total asset value of the REIT must also grow. So that is very important. Now, once we have actually looked at the property portfolio, the second thing that I will look at is the financial results. So here, the financial results, I will basically look at it from a 10-year point of view. And over here, I have actually stated a few things that I will personally look at when it comes to assessing whether this REIT is good to actually consider to invest or is something that I would dismiss. So the first one is revenues. So revenues is about rental income. And this one, over the past 10 years, it has to grow. Very important. The second one is this, the net property income. So if the rental income grows, the net property income of the REIT must also grow. And finally, after the net property income, of course, in a REIT, right, they will actually have they have some expenses here and there, and then they will come to the final income, okay, which is the distributable income. So this distributable income is actually a very important figure, because these are the figures where the REIT will actually pay us dividends or distribution. They will distribute this income to us as unit holders or investors. So therefore, the distributable income must also grow. And finally, DPU. Of course, sometimes we may have corporate exercises, but if there's no corporate exercises, this figure, the DPU figure, must also grow. So basically it's very simple. Revenue must grow, net property income must grow, distributable income must grow, DPU also have to grow. So that is actually my own benchmark. And finally, we are looking at balance sheet strength. So in Malaysia, right, for Malaysian listed REITs, the gearing ratio, okay, which means to say how they measure is this. First, they take the amount of debt that the REIT has, the amount of borrowings, and then they will divide it by the total asset value. So there's a limit to the amount of a gearing ratio that a REIT can take. Okay, so it's like this. Gearing ratio is like, let's say, imagine you have a house. The asset value is 1 million, and then you have the mortgage. Let's say it's 500,000. So you take 500,000 divided by 1 million. That's where you get your gearing ratio. So this gearing ratio, it cannot go more than 50%. So for me, if I were to say, if let's say the REIT, right, has a gearing ratio of anything below 45, actually the lower the better. If let's say they can keep it at around 30%, I would say it's good. If let's say they can keep it at around 20 to 30%, I would say it's also very good. Why? This is because if the gearing ratio is low, from an investor point of view, it also means something like this. It also means that the REIT, right, can actually got the flexibility to go to the bank to actually get more loan to buy more properties. So let me repeat that again. For a REIT that is low geared, like for example, they have a gearing ratio of 20 or 30%, these banks, they have the flexibility to go to the bank. These REITs, they have the flexibility to go to the bank to borrow more loan from these banks and use these loans to buy more properties, and therefore resulting in an expansion in their property portfolio. Okay, so that is the beauty of having a REIT that has quite a good gearing ratio. All right, they maintain it at around 30%, under 40% would be good. If a REIT has about 45% in gearing ratio, then it's very hard for the REIT, right, to actually go to the bank and borrow money and expand the property portfolio, because the gearing ratio is actually close to the limit already. It's kind of like a person who has a salary of, let's say, 10,000 ringgit, and his mortgage is already like 6,000-7,000 ringgit. It's very hard for him to keep on. It's very hard for him to convince the bank to actually disperse him more loans so that he can buy more properties. It's very hard to do that already. The logic is actually the same. Okay, so that's the financial results. Okay, the third thing that I'll look at is the latest developments are. So let's say we have a REIT that is financially strong, the balance sheet is strong, okay, it has good cash flow and stuff like that. So these are criteria that allow the REIT to invest for growth, invest to sustain the growth of the REIT. So, but then the question is this: where will it put its money? Where will it go and buy? Is the REIT gonna use the money to buy property? And if let's say they do that, what kind of property? So this is where we look at the latest developments of the REIT. So here I'll be looking at a few things. Number one, whether or not the REIT has announced the latest acquisition of investment properties. Number two, whether or not they are going to embark on any asset enhancement initiatives. So asset enhancement initiatives are like renovation. So meaning to say they may actually go and it can actually range from, let's say, works to make the building more beautiful, more attractive looking. That's one way of looking at it. Or number two, sometimes you can walk into some shopping mall. Last time the shopping mall has older concept and older concept of retailing. But after that, they know how to like manage the space better. So therefore, they do some asset enhancement initiatives. And with that, right, they can take the same space and create more rentable space lah. And because of that, they can create more rental, they can actually generate more rental income. So these are actually another form of asset enhancement initiatives. And all these things, right, you can actually find it in the REITs annual report or the quarterly reports. And last but not least, we have valuation. Okay, so just now we talked about property portfolio, financial results, and latest developments. All these things are fundamentals of the REIT. Okay, so you want to buy a REIT, or at least me lah, I want to invest in a REIT that is fundamentally strong. But I don't just buy, but then the thing is this, from the pool of fundamentally solid REITs, I don't just buy them at any sort of price. I want to buy them at a discount. Or I want to buy them at the best possible prices that I can get. So therefore, I need to do valuation. And that is why later I'm going to show you how to calculate the net distribution yield, and as well as to calculate the PB ratio of the REIT. All right, so now we are done with the investment framework, and let's move on to the next part, which is part number 3, how to assess the financial results of a REIT like a pro. Okay, so to do this, I'm going to do a case study with you today. And just now in the chat box, I actually noticed someone actually bought into Axis REIT. Yes, so today we are going to do Axis REIT as our case study for this webinar. And let's take a look. So let me just give you a background of Axis REIT. So Axis REIT is actually the first Islamic REIT to be listed on Bursa Malaysia. So the type of properties that they invest into is actually industrial properties, whereby the portfolio of properties will include factories, warehouses, manufacturing facilities, and as well as some commercial properties like offices. All right, so these are the type of properties that Axis REIT will invest into. So as of Q1 2021, Axis REIT, right, has reported to have 57 properties, and the total assets that they have is 3.52 billion ringgit. So now let's go through all the investment framework, okay? And of course, if you have any questions along the way, just put it in the Q&A box. I'm sure that Shane and I will actually get it sorted out after this webinar session. So let's go to the first investment framework. Very important. It's always about the investment framework. Property portfolio. So as you can see here, the first thing that I will look at is whether or not this REIT is active when it comes to expanding its property portfolio. And here what I can say is that, as you can see, on a year-by-year basis, Axis REIT has actually increased the number of properties that it has in its portfolio from 26 properties in 2010 to 57 as of Q1 2021. So it's actually kind of like in a growing trend based on the bar chart shown on the screen. All right, so this is pretty okay. And with growth, with the expansion in property portfolio, so of course, the next thing I will look at is the total asset value. And when it comes to the total asset value, what I've gathered is that Axis REIT has increased its total asset value from 1.21 billion ringgit in 2010, as you can see over here, 1.21 billion, 2010, all the way up to 3.52 billion ringgit in Q1 2021. All right, so as you can see here, it is actually on a growing trend as well. And then the next thing we want to look at is the occupancy rate. So over here, what I found is that Axis REIT has actually maintained a very healthy kind of occupancy rate. As you can see, it has maintained well above 90% in occupancy rate. But also, I also can see that the occupancy rate kind of like dipped a little bit from the above 95% range, and it kind of like moved down to the 90 to 95% range. Okay, so which means to say there are some properties. What I gather is that some of the properties, actually most of the properties, they are fully occupied, like 100% occupancy rate. But there are also some properties whereby they may actually achieve lesser than 90% occupancy rate. Okay, so these are stuff that we need to know beforehand. All right, these are stuff that we need to know beforehand before we actually invest in the REIT, because we want to know that how many properties do Axis REIT have that is actually how many in terms of percentage, whereby the spaces that they have is actually vacated or or not occupied. Let's put it that way. So this is actually how, as an investor, we can assess the risk before we actually invest in a REIT. Okay. So this is actually the summary of the property portfolio. So far, the gist of it is, number one, it has actively expanded its property portfolio. Number two, the total asset value has increased. Number three, the occupancy rate, we kind of see like there's a small decline, but it's still above 90%. So that is actually the first investment framework. Now we move on to the second investment framework, which is financial results. So in terms of financial results, the first thing I'll look at is the group revenues. So for group revenues, what I can see is that the revenue has actually increased from 89.2 million ringgit Malaysia in 2010, and has increased all the way up to 232.2 million ringgit in 2020, in 2020. So I think this is okay. Actually, for me, when it comes to my portfolio, right, the stocks that I will pick, right, when it comes to revenue, earnings, and all this kind of stuff, right, it must actually grow like this. All right. There's not many patterns that I will go with. This is actually the only pattern that I will this is actually the only pattern that I'm interested to look at, which is I see the 10-year chart, the sales has been growing on a consistent basis. Then I would say this is actually pretty good. All right. Now we look at the net property income. We can see that the pattern is also the same, whereby the net property income has also increased from 76.3 million ringgit in 2010, and it has increased all the way up to 198.5 million ringgit in 2020. So again, it's actually the same growing pattern that we see. Okay, it has to be that straightforward. And finally, when it comes to distributable income, it is also as straightforward as it is, whereby it has actually increased from 52.8 million ringgit in 2010, and if you look at 2020, it has increased all the way up to 126.4 million ringgit. So I think this is also pretty healthy. Okay, so far what we gather is that revenue has increased, net property income has also increased, and therefore this have actually contributed to the growth in distributable income. So it is pretty good. And by the way, as I mentioned over here, we have 18 REITs, right? Not all 18 REITs have this kind of a pattern. All right. So this is actually an illustration. So what you guys want to do is that after this webinar, you can actually go back. All these things you can get it from the annual reports from Bursa Malaysia. Okay, all the 18 REITs. You just need to go to this REITs, find out their annual report, download their annual report, and then just do a simple 10-year, just compile 10 years worth of data, and then plot the graph like this. All these things can be done via Google spreadsheet, and then you can see whether or not you will get the same pattern. Okay, and then you can actually compare this pattern with the rest of the REITs that you are interested to look at. Okay, so the financial results are okay, and now we are going to look at the balance sheet strength. So in terms of balance sheet strength, in Q1 2021, Axis REIT, right, what I've gathered is this. As you can see, this is actually an Islamic or an I-REIT, a Sharia compliant REIT. So what happened is that the reporting style is also a bit different. The first one is that we don't use gearing ratio, because Islamic REIT, we don't actually use the word debt. Rather, we use the word financing. So the financing ratio is 36.01%. So it's still below the 50% gearing ratio that we talk about. So okay lah. So that means to say there's still a room between 36% to 50%. So which means to say this REIT can still go to the bank and get more loan to buy more properties if they want to. Second, when they get financing, so we also want to look at the profit rate. So for conventional REIT, it will be interest rate or the cost of debt or the cost of borrowings. But because this is a Sharia compliant REIT, so therefore we look at its effective profit rate. And the effective profit rate will be 3.71% per annum. And now some people actually, they are very concerned about this. Say, Ian, okay, so now let's say, for example, we have interest rate or profit rate of, let's say, 3.7%. But we never know in the future, right? Bank Negara, how they what kind of rate will they announce in the future in terms of their OPR rate, the overnight policy rate. Okay, so if the OPR rate or the overnight policy rate increase, then the loan also increase. If let's say the OPR rate, they announce it to be lower, then the debt will be lower, right? So what happens is that OPR rate increase, the cost of borrowing or the profit rate increase, then the REIT will make lesser money, right? Because they have to pay more interest costs, or they have to pay more profit to their financiers. If I actually make it the opposite, all right, if let's say the OPR rate reduces, the interest rate or the profit rate also reduces. Therefore, the REIT also can make more money because they pay lesser interest costs or the profits to the financiers, right? So, if in order to mitigate this risk, we will actually look at the percentage of fixed rate financing. Okay, so which means to say these are the percentage. So these are this portion of the financing, right, or the debt, right? No matter how the OPR rate is being announced, it will be fixed. Okay, it's like a fixed rate loan. It doesn't matter whether or not Bank Negara will increase or decrease the OPR rate in the future. So here what we can see is that 46% of the financing obtained by Axis REIT is actually quite fixed. So which means to say only 54% of the thing, right, it will be subjected to, it is actually floating rate, it's subjected to the OPR rate lah. So that is actually something that we need to know before we invest, okay? And finally, I also gathered from the quarterly reports of Q1 2021 that the Axis REIT has actually recorded a net asset value per unit of 1 ringgit and 45 cents. Okay, so the NAV per unit is 1 ringgit and 45 cents as of Q1 2021. And now we are going to look at the latest developments of Axis REIT. Okay, all right, so I just want to counter check, see whether I prepare anything or not. So here, what we are going to do is that I'm going to show you straight away how do I actually get to know about the latest developments of Axis REIT. Okay, in order to do that, I'm going to show you a few ways. Okay, the most direct way is to go to the REIT website. So this is Axis REIT's corporate website. So here I can actually do a few things. All right. First one is that I'm going to click onto the quarterly reports. So for Axis REIT, right, we have the place where it has quarterly reports, and there's another place whereby we can actually have the quarterly presentations. So if let's say you're not so much of a reader, you like something visual, then just click onto quarterly presentations. Click onto this, okay, click onto this link, and you will be given a PDF file. Okay. So it's as followed on the screen. Okay, we have a PDF presentation slide of Axis REIT, the latest one. So here we have, so this presentation is actually prepared almost close to 3 months ago, on the 21st of April 2021. So we can actually take a look. So over here is that you can actually study the REIT in detail. But over here, I'm going to just highlight to you where exactly is important when it comes to latest developments. So for Axis REIT, I'll look at this section called completed acquisitions. Why is this important? Because once the REIT, so completed acquisitions are acquisitions that the REIT recently completed. So when it's recently completed, which means after it has been completed, then they can start generating rental income. And this is actually another booster for the REIT's growth when it comes to its revenue, its net property income, and its as well as its distributable income. Okay, so here, what we can see is that Axis REIT has announced the following completed acquisitions. The first one will be Indapura Facility 2 in Johor. So it's acquired at 8.54 million ringgit, and it's right now 100% occupied. The second one will be in Indapura Facility 3 in Johor, whereby its purchase price is 6.68 million ringgit, 100% occupied. You can also see the completion date over here. And then the next one will be the Bionics iPark campus in Johor. So once again, it has been recently completed, 100% occupied, and the purchase price is 12.98 million ringgit. So this is the third one. And finally, we have the Bukit Raja Distribution Center 2 in Shah Alam. So what happened is that this property is also 100% occupied, and the purchase price is 120 million ringgit. Okay, so that is actually the completed acquisition. But for Axis REIT, they also announced that they have some ongoing acquisitions. So the ongoing acquisitions over here, what I gather is this. We have a leasehold property, which is still transacting, which means to say the SPA, the sales and purchase agreement, has been signed, but it's in the process of pindah milik to Axis REIT. So it's still in the process of completing the transaction. So over here, we have a warehouse at Pasir Gudang, Johor, whereby it is in the midst of transferring the ownership into Axis REIT, whereby the purchase price is 75 million ringgit. And here it will state the target completion date, which is the first half of 2021. So over here, what I will do is this. This presentation slide, right, is prepared on the 21st of April 2021. I want to know whether this thing has it been pindah milik into Axis REIT or not. So the next thing I can do is that I can go to Bursa Malaysia. So this is Bursa Malaysia. Go to the corporate website. Okay, you see this company announcements. You can click onto this. Scroll down, select company. Okay, we have Axis REIT. Just click onto search. And over here, we can actually see whether or not are there any announcements that they say that this particular piece of property has been completed when it comes to its acquisition. So you can just scroll all the way down to its date, the date where they prepared this presentation slide. So apparently over here, I can see that this particular transaction, right, is still ongoing and it's not yet completed, because after I scroll down, I look at the announcements, right? There's no announcement that say that this property has been completed. So we're still waiting, okay? But nevertheless, if let's say this thing is completed, then it will be property number 58. Okay, and over here we have reviewed. Axis REIT will review their acquisition strategy, and this is actually just reading materials. So when it comes to figuring out what the company or what the REIT will do for the future to sustain its growth for the future, basically investors do not need to speculate. They don't need to second guess where the economy is going to go, what will the market do, what the company is going to do. Usually good companies or well-run REITs, they will always tell you what they will do. So you don't need to speculate. You just need to read. You just need to find this information, and then you figure out whether or not you want to participate in the company's growth or not, or the REIT's growth in the future. So it's all about reading. You don't need to really speculate. And last but not least, we are going to come to the final investment framework, which is where I'm going to share with you how to calculate the net distribution yield of a REIT. Now, this one, you can't get it from screeners. I'm going to demonstrate to you one time how you can do that. And then you can do this for you can actually do this for multiple years. Okay. So this demonstration is very important. If you can pay attention closely to where I click and how I actually do this. All right. So in order to do this, I'm going to just open up a spreadsheet. Okay, so this is a spreadsheet. And let's make it big. Okay, let's make it a bit bigger. So I'm going to calculate the current net distribution yield of Axis REIT. So the current net distribution yield will here what we'll do is that we'll calculate the current. So which means to say we'll take the latest 12 months figure. Okay. So the first one I'm going to put period. Make this into center. And then what we need to do is that we need to this one we can only rely on Bursa Malaysia website. No choice. Only one place you can find this kind of information. So over here we will find this thing called income distribution. So we need to actually take every single announcement which says income distribution. So here, this is the latest one, and I'm going to click onto this. So as you can see, this one, okay, so this income distribution is related to the latest quarter, which is Q1 2021, okay, because it says in respect for the period from 1st January 2021 to 31st March 2021. So this is Q1 2021. So I'm going to just put here Q1 2021. Now, when it comes to income distribution, the total income distribution is 2.23 cents. But in Malaysia, the income distribution, right? It consists of two things. Number one, the taxable portion of the income distribution, and the second part is the non-taxable part of the income distribution. So the taxable part is subjected to a 10% withholding tax. And this is the figure that we need to net it out. And then we have the second part, which is a non-taxable, where this non-taxable, over here it says 0.5 cents. This one, you can get it in full, okay? So over here, what I'm going to do is that I'm going to compile the taxable DPU, and as well as the non-taxable DPU. Okay, let's put this. So what do we have here? So the taxable one is 1.73 cents. The non-taxable one is 0.5 cents. And therefore you have the total, which is 2.23 cents. Okay. Done. So now we will actually go and back. We are now going to go back into the Q4 2020 to get the same information. So let me just go straight into that. So the problem is that for screeners, unless the screener providers, they painfully go and they go and like do all these things, they go and dig out this kind of information one by one. Otherwise, I believe that investors, the only way about it is to go and find this kind of information. Okay, so we see here income distribution. So we click onto this. So we say here we have dividend investment plan. Okay, so guys, if let's say you're new to REIT investment, dividend reinvestment plan is actually an option. You can actually either collect cash, your income distribution in the form of cash, or you want to get more Axis REIT units. Okay, so you can receive it in the form of units, or you can receive it in the form of cash. Okay, so you can actually vote, you can elect, whichever is more, whichever that it makes sense to you. So here, what we find is that, okay, so back to the net distribution yield, what we find is that here's the period between 1st of October 2020 to 31st December 2020, whereby the total income distribution is 2.25 cents, of which 0.83 cents is taxable, 1.42 cents is non-taxable. So let me just quickly compile that into my spreadsheet. So this is 1.42. So therefore, the total DPU is 2.25. Okay, so now we are going to move on to Q3 2020. Now let's continue. So of course, along the way, you may ask, how do you calculate, how do they calculate which part is taxable, which part is non-taxable? This one, unfortunately, it's actually the accountants, the financial people at the REIT will actually do the computation. For investors, we don't really have a formula. It's not given very clearly how they actually differentiate between what is taxable and what is non-taxable. So the best thing that we can do is just to find out what are the figures, and then we just put it into the spreadsheet, like what I'm actually doing right now. Okay, so this is the next one. This is for Q3 2020. So as you can see, we have the total gross income distribution, which is 2.25 cents, and of which 1.84 cents is taxable and 0.41 cents is non-taxable. So we put here 1.84, and then here we put 0.41, and therefore the total DPU is 2.25. Now, can you see that these two, right, are the same figures, 2.25 cents? All right, so although the gross DPU is the same figure, but at the end of the day, what is credited, the amount of money that is credited into your bank account can be very different because of the composition of this DPU. The amount that is set for taxable and the amount set for non-taxable can actually make a difference in how much is being credited into your bank account at the end of the day in terms of income distribution. So please take note of that. Last but not least, we are going to look at Q2 2020. And therefore, let's continue to scroll down. So you may say, hey, this work is actually quite lengthy. All right. So is there any way around it? Actually, all these things, right, you can take, actually, it just take a few, you can say a few, if you just want to calculate the current one, it's going to be a few, maybe 5 to 10 minutes, but it's worth it. Okay. So spend some time doing it because we are investing our hard-earned money into something. Okay. All right. So we have the Q2 2020 results. Total DPU is 2.15, 1.64 is taxable, 0.51 is non-taxable. Okay, so let's put it in. So therefore, this is 2.15. Okay. Now, here's how I'm going to calculate the final DPU. Okay. So let me copy this down. So the non-taxable, we are going to collect this in full, confirm, 100% because it's non-taxable. But for the taxable portion, we have to minus off the 10% withholding tax. So this is DPU after withholding tax. Okay. So what we do is that we take C3, which is the taxable DPU for Q2 2020, and then we just multiply by 90%. Okay, and this is all, and all these figures are auto-generated. So the final DPU that we get for the past 4 quarters, I can actually just sum it up as follows. Autofill. Okay, so can you see that this is the total net DPU that we receive, which is 8.276 cents. So this is the final amount that investors will receive over the last 4 quarters. So the total DPU here may be 8.88 cents, but the final amount that we get is 8.276 cents. Now to calculate the net distribution yield, we need the current stock price of Axis REIT. So what I do is that we can, the fastest way I would do is that we'll go to Google Finance, and then we just take Axis, we just type in Axis REIT. And here what I say, and here we find that the latest stock price for Axis REIT is 1 ringgit and 91 cents. So we just put here RM1.91. But here I have to make a note because this one is Malaysian cents. For stock price is actually ringgit. So therefore the net distribution yield what I'll do is that I will take E15 divided by 100 because I need to convert it into ringgit Malaysia. And then I will divide it with the stock price of the day, the latest stock price, which is RM1.91. So it's E16. And then I'll just make it into percentage. So there you go. So this is the current net distribution yield, which is 4.33%. Okay. And for me, right, what I will do is that for me, I'm a bit crazy. So what I will do is that I will go back and I will actually compile for every single year what is the net DPU. And at that time, I also go and compile what is the closing price at that time. And then I will calculate every single year's net DPU. And after that, I will actually compare it with the 4.33% here. And from there, I can value whether or not this REIT at RM1.91, is it undervalued, fairly valued, or overvalued? Okay, so this is actually how I do it. Now, I'm going to just move in very quickly to actually share with you how to calculate the PB ratio of the REIT. Okay, so the PB ratio of Axis REIT is very simple. So let me just see whether I can find you. Okay. So here it says that the net asset value per unit is $1.47. Okay, so we just take this figure. So the net asset value so you can actually either take the 1.47 or sometimes a REIT will actually present two figures. So it depends whichever figure you want to use, whichever you feel that it's actually more comfortable. So this is the quarterly financial report of Axis REIT. So typically we can actually look into these two figures, okay, whichever is more comfortable. So why sometimes I don't use 1.4. Just now I look at 1.47. I have I would say you can say the vision or the acumen that I may not use 1.47. I may use 1.45. Typically for me, I will use the net asset value after the income distribution. All right, so this will be the one. So instead of using 1.47, I'll be using 1.45. So let's put it here, 1.45. So what we do is that to calculate the PB ratio, I'll take the stock price, which is E16, and then I will divide it by E19, which is 1.45. And there you go. So the PB ratio at stock price of $1.91 will be 1.32. And then I will go back. I'll go back to the past 10 years of Axis REIT. I'll calculate the PB ratio for every single year. And then from there, I will compare with the 1.32 in order to find out whether or not this Axis REIT at RM1.91, is it undervalued, fairly valued, or overvalued? So that's how I do it. Okay. So let's go back to our slides. And with that, I think I have come to the end of this presentation. Thank you so much for following, guys. And of course, I believe that you guys have a lot of questions to ask. Please do ask them. And right now, I'm going to pass back to my man over here, Shane Chu. Shane, all yours.
Thank you so much, Ian. All right, so I think today we learned what REIT is and also learn about how to get the net distribution per unit and also how to calculate the net distribution yield and also know how to get the price to book ratio. So Ian has shown us through the mathematical calculation. So if any questions for Ian, right, please write in the Q&A box. Okay, I believe some of the questions have been answered have been answered by Ian before. Let me see. Okay, this question is interesting. Now, Ken Singh would like to ask, on expansion of property portfolio, can REITs issue a rights issue? to fund the acquisition or only through the bank borrowings?
The answer is yes. Some REITs really do rights issue. They can do private placement, they can do rights issue, okay? They can do all this stuff to actually, and as well, or a combination of rights issue, private placement, and as well as bank borrowings to go and finance the acquisition of a property. So the answer is yes.
Okay. Raymond would like to ask, is any profit from the sale of the REIT unit subject to the real property gain tax?
So this one is actually very interesting, and the answer I believe is yes. Of course, I mean, even in individuals want to sell off property, okay lah.
What he means is like you sell your REIT unit, not the REIT properties.
The sale of the REIT, the sale of the REIT units, no. There's no capital gain tax over here, no. Okay. So the answer is no.
Yeah. So if you sell property, you make money, right? Then it is yes lah. But instead of buying the property in in KLCC, right? You buy into KLCC REIT. So when you make money through KLCC REIT, it's not it's tax-free. It's capital gain tax. Okay, no capital gain tax, so it's tax-free. But if you own property in KLCC, you want to sell off your KLCC property, then you need to pay the RPGT, real property gain tax. Okay,
correct.
So this is the benefit of the REIT. Okay. Let's see. If the number of properties increases, the total asset value should also be in growing trend, right? That's by Jude Xiong.
It has to be lah. It cannot go in the opposite direction lah. If it's in the opposite direction, right, that means the property must be something really messed up happened to the property lah, or the property value, don't know for what reason, depreciate lah. So I will be very wary of very wary of all these kind of REITs. If let's say the total asset value kind of like drop consistently over time, so that will be a no for me.
Okay. Now Jing Kyun would like to ask, like, is the gearing ratio only applicable on mortgage loan? How about the company working capital loan? Usually
for REITs, right, they have very little working capital loan. So it's actually mostly mortgage loan over here.
Is the depreciation cost need to look into consideration when looking at REITs? This is by Wee Kok Chen.
For me, I don't look at depreciation costs, okay, that intensely. All right. So what is important as a REIT owner is that number one, the rental income, because we have to look at the objective of why we invest in a REIT. Number one is to get passive income distribution from the REIT. So where does this income distribution come from? It comes from the rental. So I will look at the rental first. Okay. So depreciation cost is actually a non-cash item, but it's still important. So they may record something over there. And actually from there, after they deduct all these things, they will finally come down to the distribution income. So I tend to track the rental income, which is the revenue, net property income, and distribution income. Actually, if you check these three, right, and it's all on a growing trend, typically you will actually filter out all the not so good REITs from the good REITs already. Let's put it that way.
Having said that, now personally, I don't look at REITs so regularly. Are the costs, what are the assets that can be depreciated in the REIT? Like, do they have machinery to be depreciated?
Maybe the elevator, the lift. The elevator could depreciate, isn't it? Okay, maybe. So let's say you install elevators, and then the elevator is part of the property, and then it can last for 20 years or something like that. Or every 20 years, they have to change the elevator into a more high-tech or more modern kind of elevator. So that is actually part of the capex to enhance the property value, and that one of course got depreciation costs. All right. So that's just one example. Of course, the toilet, I mean, the toilet, the sink, the toilet also is also part of capex, right? So you want to enhance the toilet, there will be depreciation costs. So So all these things are in. So all these things are in place. It's not just of course, the toilet is just a joke, but yes, there's some truth element to it. But we can say that the lightings, the furniture, the facade, the elevator, the tiles, whatever is inside or installed on the property could be capex that will actually translate into some form of depreciation costs.
Okay, I see. So the follow-up question is, do you look into leasehold tenure terms before you invest in REIT?
This one, interestingly, for Malaysian REIT, I don't think it's a big concern lah. Okay, because sometimes the lease balance, right? I mean to say some of the lease balances like 80 years, 90 years. So if let's say today you're 40 years old and then you plus 80 years, right, you'll be 120 years old. So so I don't think that part is a huge concern. Unless you're looking at overseas REIT where the leasehold structure could be a bit different, whereby the leasehold structure, okay, let's say for example, wait, can say or not? But Malaysian REIT, you don't need to worry about this lah. Other country whereby the leasehold structure may be a bit shorter, then yes, let's put it that way lah.
Okay. The next question is, in your opinion, do you think that the current pandemic affect the REITs, or it is still the REITs are still doing well?
Of course, it will affect. Of course, it will impact the REIT. Okay, the first one. Okay, you talk about hospitality industry. Okay, it's impacted. Everyone's on a lockdown mode. No cuti Malaysia. No foreign visitors, and of course, your hotels will be impacted lah. So in a way, like let's say for example, YTL Hospitality REIT, it has been a really good REIT. It has actually paid out quite consistent amount of dividends and stuff like that. It has to restructure its lease structure. It has to restructure its lease agreement with the with the hotel operators, which so happens to be YTL, owned by YTL Corporation itself. At least for YTL Hospitality REIT, at least they got a big brother to take care of them lah. Let's put it that way lah. Luckily they are not because based on the lease structure, okay, most of their hotels are actually run by subsidiaries of YTL themselves. So that one is like big brother taking care of little brother, then okay lah. Then you will still be able to survive. Impacted, but you still can survive. Okay. The second thing is that the good thing about why we invest in a REIT. So like for example, if you want to talk about shopping mall REIT, then shopping mall REIT, all the retail malls like Sunway Pyramid, you can go to Sunway Pyramid, Mid Valley, or if you're living in Penang, you can go to places like where? Gurney Plaza. Go and check it out lah. I mean, go and check out the mall, go shop around, see whether or not that. So these are few trips. This is typically, let's say, okay, now let's say, for example, you want to buy some company, some manufacturing company stocks. You can't go, it's very rare for you to go to some people's factory to actually look at the plant. But for retail REITs, retail mall REITs like Sunway REIT, or not I say Sunway REIT is quite diversified, but let's say IGB, you can go around Mid Valley, just spend a few hours and see whether or not you find any vacant lots, empty shop lots. So if you find some empty shop lots, then you know already like, oh, no people want empty shop lots, business not good, then you know something is wrong lah. If let's say the business is good, retail spaces are occupied, it's always busy, it's always hectic, then very good. But of course, during this pandemic, because of the lockdown, of course, everything will just drop. All right. So here, my take is that I personally will stick to the fundamentals. I believe in investing. So because of the pandemic, of course, this is actually a time for investors to come in and grab the same piece of property at a lower price, because we actually kind of like assess the REIT based on its true ability of making money, true ability of generating profits before COVID era. Because we also believe that we are also optimistic that somehow or rather the economy, the market will work around the COVID-19 and somehow we can emerge stronger from it. So that's why we will go and base it on financial records before the COVID-19. So that's how we actually assess it. So you say got impact or not? I would say definitely got lah. So it's up to us to actually assess what is the impact and whether or not we can actually take on the risk.
Okay. Siwei would like to ask, is there an optimum price level of the price to book ratio?
There's no optimum lah. So typically I will take some time, compile the 10 years record, and then this 10 years record, right? And I see in the question, right, any website provide this calculation? The answer is no lah, not do I know of lah. Okay, do your own calculation. That's the best. Okay, so the thing is that you go through it. What I'll do is that you take the 10 years average. So let's say a 10 years average of axis rate, I do not know. Let's say it's 1.5 and right now it's 1.32, then good. Okay, so then I know that okay, the PB ratio is below 1.5. Okay, so at least I know that before I invest. But if let's say I found out that axis rate on the past 10 years, the average PB ratio is 1.1, and right now I calculated that it is 1.32, then I know that it is above. It's now trading above the 10-year average lah. Then it depends how much I like axis rate lah. If I like it so much that I go in. If I think that it's a bit overvalued, then I don't go in lah. I don't accumulate at that point in time lah. I just wait for it to drop before I come in and accumulate the units.
So in your opinion, right, what is the average PB ratio for the Malaysian REITs? Are they often trading above 1?
Yes and no. The good ones will have a higher PB ratio because they are higher demand. The bad ones, right? The ones that the revenues are dropping, the net property income dropping, distributable income also dropping. These are something that people don't want lah. Then of course the PB ratio will be low, usually below 1. So usually the good ones you can see that it's close to 1 or above 1. Usually the not so good ones you can see the PB ratio is maybe 0.5. I do not know, in that range lah.
Okay. Can you compare Malaysian REIT and Singapore REITs?
Is it okay? So if you allow me,
yeah.
So if you allow me to make the distinction, okay. Singapore REIT is a more mature market lah. That one very hard to. It's not so hard to dispute lah because they have more. Okay, number one, Malaysian REITs, we have 18 REITs. In Singapore, we have over 40 plus REITs. Number two is that Singapore REITs are not just Singapore properties. Singapore REITs are quite global. So which means to say it's a gateway for people to participate in a much more globalized property portfolio. Okay, so if you have a hospitality REIT, they may have hospitality REIT whereby they own hotels in many other places like Asia Pacific, US, Europe, and Australia. So they have it. So if you are into that kind of globalized field, then Singapore REIT could be one of the options lah. Okay, so typically these are the two main key differences, and of course the tax structure will be a little bit different. But with that said, right, also if it depends on what broker. If let's say you invest, right, it also depends on what brokers you use. Okay, so if you use a broker, so the different broker will actually charge you different fees. So there will be a dividend handling fee depending on what broker you use when it comes to collecting income distribution from a Singapore REIT and as well as a Hong Kong REIT.
Okay. Yeah. So what is your view of the upcoming IPO IGB commercial REIT? This is by George Tay.
Usually we don't look at opinions. I go by investment framework one. So which means to say we just like the 4 investment framework that I talk about. I look at the property portfolio, the financial results, the latest development, and as well as the and as well as the valuation of things. So usually I go through that standard checklist lah. So usually, so if you ask me about IGB commercial REIT, right? Of course, it has 10 properties. It's located in KL in the Golden. Okay, there are 7 properties that are located in the the Mid Valley city center, that area, very close to the gardens, Mid Valley. And there are 3 more properties that are in the Golden Triangle of KL. So location wise so let me say they are located in these areas of KL. But the thing is that now I throw back the question to you. Okay, so what do you think about the supply of office spaces in KL, whereby we have, what are the mega projects that they are coming up with? We have the TRX, we have the Menara PNB, right? And then we have the Kota Warisan, or the Merdeka Tower or something like that. So we have, or the Bukit Bintang City Center or something like that. So we have a lot of projects coming up. Then from there you can assess whether or not will this impact the office, will this impact the supply and demand of the office space in KL. So that is actually something that investors should actually give it a thought first before investing into the REIT.
Okay. Daniel Van would like to ask, will injection of newly completed asset without the track record of achieving the minimum yield affect, so let me rephrase because the sentence is a bit long. Will the injection of newly completed asset into the buying REIT drag down its share price?
If it's a good property, usually it will usually be a good one, unless it's a bad one. So it depends on the quality of the property.
Okay. Now, do you mind to share with us which retail mall has the highest occupancy rate? Okay, I think let's put it on retail REIT instead of retail mall.
Actually, most of the retail, okay, these things are, you don't need to, these things, okay, you see, let's say pre-pandemic, you can see that IGB REIT, the Gardens Mid Valley, Sunray Pyramid, and what other REITs like? Okay, like maybe Surya KLCC, the KLCC Staple Securities. You can roughly gauge that from the annual reports. What I remember is that they have above 95% occupancy rate. Okay, actually, you can actually read that. If let's say you are not from the Klang Valley, of course you have to rely on the annual report to actually find out all this information. But if you are in the Klang Valley, and of course if the lockdown is lifted up, just go and visit the property and spend some time there, enjoy some time there. Then you will know you have the vibes of it, you have the dynamics of it, because you see it, you can feel it, and then you can validate the information via your annual report. So via your readings from the annual report. So actually all these things are readily available information. You can actually get it lah. But if you ask me which shopping mall, right? So these are the shopping malls that I think that I find that from the annual reports, so it's above 95% occupancy rate.
Yeah, those shopping mall that you go, right, cannot find parking one. These are the one that very okay.
And by the way, car park is also an income source to the REIT so every time you go in and come out a few ringgit, right, or tens of ringgit, that's the income to the REIT already lah.
Yeah. Okay. Yeah. So next time those you cannot find parking on, these are the REIT that you should look into. Okay. So that follow-up question by Daniel is that what is the penalty to be imposed by a Securities Commission if the REIT fails to bring down the asset to debt ratio to within the prescribed 50% when the COVID-19 grace period is over?
There's none. So nobody break that ruling yet. So it's something, if it happens, it's unprecedented lah. So we don't know yet. Nobody break the law yet.
Okay. Now, Johnson would like to ask, like, which sector of the REIT do you think is attractive at the moment? Is it diversified, industrial, retail?
I mean to say it depends. Very hard to say. Okay. Of course, if you ask me, it's actually very hard to say lah. All right. So of course, it's not to say now today if I say industrial, then does that mean that everyone will go and focus on X REIT? If let's say I go and say office REIT, does that mean that you guys are going to go into IGB commercial REIT? So I mean to say it depends, law. I mean to say you can have your pick and preference lah. Okay. So which means to say what is important is how the REIT, how the management actually run the whole show. Okay. So it actually really depends on the management of the REIT and the type of properties that they have. Some REITs, like let's say Sun REIT, they want to have a diversified portfolio because that's their management style and that's their direction. They want to be more diversified. Okay. So that is actually their thing. So if you like their management style, that's how they do it. Fine. That's the way it is. If let's say you like if you like something like, okay, Axis REIT, which is very industrial focused, okay, and you like that kind of style of management, then of course, then that will be the REIT to go for lah. And of course, there are some REITs which are not so well run. Then you look at them, you say, oh, the occupancy rate is actually very low. Then no lah. Then don't go for it lah.
Okay. Now, Marcus would like to ask, how often do REITs revalue their properties?
Sometimes, at least once a year.
Okay. Lee would like to ask, investing in REIT is also subject to price fluctuation like shares market, besides the return in investment. So how safe is REIT compared to shares?
What is the definition of safe? So that is actually a key question. What is safe to you? Okay. So for me, when I buy a stock, okay, I buy because I like the business. I buy because I like the management. I'm okay with the financial results, and I want to participate in the growth of the company for the long term. So to me, the price fluctuation up and down, I'm less sensitive towards it. Okay, except for if let's say the stock that I buy, it kind of like drop in prices, then I would say, okay lah, this is the time for me to come in and accumulate more of this kind of shares lah. So which means I'm not here to trade. I'm not like, oh, Axis rate is 1.91. I hope that I buy it and it goes up to $3 and then I sell. That's not my point. Okay, that's not how I play. That's not my game lah. My game is I buy it at 1, or let's say or 2 ringgit, for example, and then every now and then I will collect dividend income. And then the next year comes in, I still hold that same stock. It gives me the dividend income. All right. Or I have more savings at the time, I will top up and then I will get more and more dividend income. So that one will be more of my game than trying to figure out where the stock price will go in the long run or in the short run. So price speculation is not something that I know of.
Okay. Oh, this question is very interesting. By Kalai Kumar. Okay, I'm not sure if you know, but I do ask anyway. Does the changes of the design code impact properties value, such as earthquake-resistant design building due to insurance coverage?
I haven't go that far yet lah. I when I buy into a REIT in Malaysia, I never thought of earthquake because being born in Malaysia and having lived and having being bred in Malaysia for my entire life, apart from that tsunami, I haven't experienced any earthquake in my life. So maybe as an investor, I didn't really look into that consideration. Maybe it's that feel that, oh, I go to some shopping mall, I still can walk inside the shopping mall, I feel safe parking my car in the shopping mall. There's no flooding. I go into the shopping mall, I come out in the shopping mall in one piece. So I never really thought about this earthquake earthquake design and all this kind of engineering stuff lah. So I didn't really consider that.
Okay. This is asking opinion. Why are Malaysian office REIT like Central, UOA, etc. are trading below their book value when office rental is not as badly affected as retail REITs?
That one I don't know, because you see in Malaysia, I mean in the whole world, different people buy stocks and sell stocks for very different reasons. Okay, so which means to say I do not know what exactly is the objective of buying or selling that particular share, because there are millions of participants. So for me, I buy because I want dividend income. So that's my objective. Okay, I'm not into price speculation. So that is actually my objective. But we have millions of people who buy and sell stocks for very different reasons. And because of that's why the price will fluctuate every now and then in the short term. Okay. So therefore, if you're into price, if we can't actually tell the behavior of the market, at least that is actually my point of view. So which say, if you want me to explain why office REIT is trading, is it office REIT trading below the retail REIT?
Trading below the book value office REIT.
Then I mean to say, I do not know lah. Okay, I do not know. But I would say one thing. It depends on what retail REIT do, because some of the retail REITs, they are pretty okay. Okay, if they're pretty okay, they should actually be trading at a higher PB. If let's say the retail REIT is actually not too good, the occupancy rate is low and all this kind of stuff, it should actually be trading at a much discounted PB ratio. So it depends. So I wouldn't say that in general all the retail REITs are at certain PB ratio. It's not fair to say that, because I also know that there are some retail REITs that are in another category of PB ratio, and it all depends on the quality of the REIT.
Okay. The next question is, sometimes the profit will drop or even record losses due to property assessment. Will that matter in terms of fundamental?
Yes and no. Okay. So you want the capital. So in the long term, you want the property to appreciate in prices. You want the properties to appreciate in value over the long term. So this is very important because if one day the REIT sell off the property, then the gains from it, right, they can actually distribute these gains to you. All right. It can be one-off. It can be on a recurring basis, or they may not distribute the gains, but they will take the gains and then buy new property, or maybe they will par down their debt. So it depends on what they do after they have sold off the property. But if let's say the property consistently record depreciating value, that means the value keep on depreciating over time, then the REIT will not have the luxury to do that. So I would prefer it to appreciate in value over time rather than depreciate.
Okay. The next question is by Shah. Do you know of any Malaysian REITs declaring more than 7% dividend yields right now?
Usually they are, but to be fair, this is okay. So I see a lot of people asking about PB ratio and dividend yield. So here I also want to share with you something. These are not the main concerns for investing in a REIT. This will be the last thing that you want to measure when it comes to investing in a REIT. I know it sounds like a bit counterintuitive, because everyone goes into REIT wanting, valuing the price, the PB ratio, and then you want to get the highest dividend yield. Actually, that's not the whole picture. Okay. Simply because the first thing that people should actually, I believe from my own experience, people should look at the quality of the property first. Then only we talk about the view. Because for me, I want to build a sustainable portfolio. Okay. It's not about the dividend yield. Dividend yield will come second. The primary one will be the quality of the property. Why? If let's say you go with the dividend yield, which is like 7%, 8%, 9%, 10%, right? Okay. And if let's say the REIT that you pick is actually not so good in terms of quality, then you might get yourself into value trap. So you may get the 7% in the first year, but then the second year, because the distributable income has declined, then your share price also decline, your dividend yield over time also decline, then that's not too good already for your investment performance. So the lesson is this. Well, yes, you can go with the highest possible dividend yield possible, but go with the ones with the better quality properties so that you can avoid all the value traps.
Yeah, that's right. It's like you invest in stock market, right? You often go for, PE2, PE3, PE4 companies without looking at the fundamental first. Then chances are you'll bump into some traps also.
Yes.
Yeah. All right. Thank you so much, Ian, for very insightful sharing on REITs in Malaysia. So let me just carry on with the next webinar. So before we talk about next webinar, as usual, Bursa Academy. If you have not checked out Bursa Academy, yes, you can go to www.bursaacademy.bursamarketplace.com. It is a comprehensive one-stop e-learning platform to give you a lot of investing resources that you can find out there. So for our next webinar, it is happening on this Friday, where we will talk about pelaburan berasaskan nilai dalam saham patuh Sharia. So we'll talk about value investing in the Sharia compliant stocks. Okay, so it's happening on this Friday, 9th of July. So 8:30 to 10 o'clock. So the registration link I just given you in the chat box. So you may register yourself. You want to learn how to do value investing, okay? In particular in a Sharia compliant manner. So yes, join our session when I talk about value investing in Bahasa Melayu, okay? So we'll be doing this in a BM. So with that, thank you so much, Ian, for sharing with us, how to invest in commercial real estate via real estate investment trust. I hope that today you're going to get a lot of ideas about real estate investment trust, how to calculate the yield, what are the process that Ian used, okay, what are 4 things that he look at, okay, before he invests in REITs. And then, very importantly is look at the quality of properties, the properties that the REIT has. And then, if you invest in REIT, then the advantage of REITs is that they are tax efficient. Okay, you can save a lot of tax because instead of the corporate being taxed at 20%, REITs does not subject to corporate tax so long that it give out more than 90% of dividend, 90% of their earnings to you as a dividend. So with that, thank you everybody for joining this, and hope that you all have gained a lot. See you on Friday.
Right. Thank you so much, Shane. See you guys, and glad to be here.
All right. So this is Shen Chu signing off. Bye-bye.